The calls on Wall Street that the Fed will be more aggressive this year continue to grow. The latest to join the chorus is JPMorgan, which is now calling for 7 hikes this year, up from 5 following yesterday's Fed minutes. Let's bring in the man behind the call. Michael Feroli is chief U.S. economist at JPMorgan. It's great to see you again, Mike. Welcome.
Hi, Kelly.
So why the minutes, which, to the markets at the time were a little bit of a snooze event, but to you they were significant?
So it's really a number of developments here that have led us to rethink our Fed call. Obviously, the inflation news last week was not only pretty high, but some of the details of the numbers suggest that this inflation is going to be with us for a while. I think some of the Fed rhetoric, even outside of the minutes, is consistent with even the doves turning toward a more steady path of rate hikes. I do think the fact that other developed market central banks are getting more hawkish also probably gives the Fed a little more leeway to increase rates more steadily without provoking a big reaction in the dollar. So all these factors suggest to us that it doesn't look like the Fed will indeed pause when they start QT, which we probably expect sometime this summer, and that there probably won't be enough of a deterioration in financial conditions, perhaps, that would cause them to pause either. So right now, it looks like they're going to probably be on a hike-a-meeting schedule until things until things turn around here.
So you basically expect the number of quarter-point rate hikes as meetings that are left this year. And you pointed out that Mary Daly of the San Francisco Fed used the word measured to describe the pace of hikes, which we saw when they did the same thing in 2004 to 2006. How bad would the Russia-Ukraine situation have to get to deter them from that kind of approach this year, or to deter them from starting next month?
Sure. So, it was interesting those minutes pointed to Russia-Ukraine as potentially a downside growth risk and an upside inflation risk, which on the face of it would suggest a bit of a dilemma for the Fed.
Hawkish, yeah.
Yeah, but I think in reality what you have seen in the past is when you have these big price spikes in oil, the growth effect tends to be more important for the Fed if inflation expectations remain reasonably well anchored, which they have, thus far, even with all the inflation news we've seen. So I would expect Russia-Ukraine, particularly if it got really nasty, the focus would be more on the adverse growth developments. Would that be enough to get them to not go in March? Hard to say unless you had a really big deterioration, particularly in market conditions. But I think most likely, even though in principle it's a dilemma, I think the Fed would probably focus more on the adverse growth implications.